let's talk about stocks. A stock, also known as a share, is a piece of a company. So buying one of these means you own part of the company. Companies issue shares as it gives them the chance to raise new capital. At first, these shares are privately held, meaning they can only be bought by certain people, but they become available to the public to buy when there is an initial public offering, an IPO. Before the IPO, big companies typically have a stage called the pre-IPO, which is when these shares are sold to investors in the private market. Now, the private market is made up of financial institutions, banks, wealth managers, anybody who's trying to build wealth for their clients. The private market is also open to very, very wealthy individuals. Investors look to buy shares in a company with a positive future, as if the share increases in value, they can then get a lot of money for it when they sell it. Now, each company has a limited number of shares, so when many people buy shares of a company, the value of each share increases. But when many people sell the shares at the same time, the value of these shares goes down. This is because when many investors sell their shares at once, it's usually because the company is doing badly. And these investors are trying to get back some of the money that they put into this share, as they realize that if they leave it there, it's just all going to go, because they would have lost money as the share has such low value. This shows a lack of faith in the company, meaning that the value of these shares decreases.